Welcome everybody to yet another Metallic Group TV webinar. Where we'll be talking to Brien shortly about the commodity sector itself and where he sees prices going and where we are in the burgeoning bull market for commodities. Before we do that, I'll give you an overview of Granite Creek and the Metallic Group. So Granite Creek Copper, we have a project in the central part of the Yukon, Canada. And we're a member of the Metallic Group, and the Metallic Group consists of two other companies, Metallic Mineral, which is focused on high-grade silver in the Yukon, and Group 10 Metals, which started in the Yukon, but is now focused on battery metals and PGEs in Montana. So we have a similar business approach for all three companies in the group, and that is to acquire large brownfields land packages at the bottom of the metal cycle, and then use modern exploration techniques to advance those to either formal resources or growth of resources, creating long-term shareholder value. We've been successful in all three companies in doing that, and we are now either with formal resources in all three companies or near-term resources and growing those resources. But today we want to talk to you about Granite Creek's project, our Carmacks project, located again, central Yukon. Excellent infrastructure on the project. We were within 12 kilometers of hydroelectric grid power, and we are within about 30 kilometers of paved highway. And you access that paved highway through an all-weather road maintained by the Yukon government. Once you get to that paved highway, it's a short drive to the village of Carmacks, through the capital of Whitehorse, and ultimately to a deep water port at Skagway, Alaska, where there's offtake facilities. So everything's in place for the development of another project. The company has a resource. We recently announced the growth of that resource based on around 10,000 meters of drilling done in last field season, where we grew the resource by 43% to give us our current resource of 36 million tons, grading 1.07% copper equivalent, and that consists of 0.81% copper, plus some precious metal credits, gold and silver, giving us just over 650 million pounds of contained copper, split roughly 50-50 between an oxide and sulfide resource. Now, based on that updated resource, we have started working on an updated preliminary economic assessment that we will be delivering later this year. We are hoping to be able to get projected mine life to greater than 15 years, somewhere in the 15 to 20 year range. And that is based on those current resources and using a lot of the work that was done in the previous PEA, which was published in 2017. So yeah, that's the company in a nutshell. Good resource, high grade copper, central Yukon, good infrastructure. And again, launching an updated PEA to show the improved economics of that resource. Yeah, that's about us in a nutshell. Chris, you still there?
I'm here, Tim. You're so concise.
Yes, very, very fast. So.
I would invite questions to come in. We've already had a few come in, and one just very basic one is how has it been working in Yukon? And there's a little nod to some of the majors and that activity that we've seen in the Yukon of late.
Yeah, absolutely. Yukon is an excellent jurisdiction. We get great support from the territorial government, great support from local communities. Yukon's a well-known mining jurisdiction with operating mines, 3 operating mines now. And yeah, the reference that you made to the majors continuing to make a significant investment into the territory, including Rio Tinto, who invested significantly $26 million in a company that's literally just down the road from us, Western Copper's casino project. And of course, you know, other majors like Teck and Newmont continue to make significant investments into the territory. So excellent jurisdiction to work in, and that goes along with the excellent infrastructure on our project.
I just had to click my microphone off. I don't know if you can hear that. I think they're coming to get me.
You have to move again?
Yeah, I have to put on my disguise. I want to get into this with Brien. He's just a slight delay. He had another interview he was doing, but the copper market itself. I mean, there's a couple of things we were talking about recently in terms of the way that projects get valued, and how we see that as it applies to Granite Creek, but just the copper market in general. What we're seeing now with metals prices, commodities, push for critical minerals supply, and so on.
Yeah, I think one of the key takeaways is that you're starting to see junior companies like ourselves, when they produce PEAs, you look at what they're using for a base price for copper, and you usually would use somewhere around the trailing 2-year average. And we've seen companies start to use numbers that are above $4 as a base case. I think we've been above $4 for around 18 months now. I don't see it going down anytime soon. I mean, one of the big drivers is our conversion to an electric economy or electric age, where everything is going electric, whether it's music, data storage, and as our transportation fleet transitions to an electric fleet, we're going to see a huge demand for copper. I don't know if a lot of people realize this, but there's 5.5 times on average the amount of copper in an electric vehicle versus a conventional internal combustion vehicle and ICE. So if you're driving a regular vehicle right now, and you went out and bought a brand new Tesla, the amount of copper in that vehicle will jump by 5.5 times, from roughly 35 pounds to over 120 pounds. So huge jump. And of course, whatever energy source that you're talking about, whether it's solar, wind, tidal, they all are huge consumers of copper. So I think the copper space is an excellent place to be. I would recommend everybody have some copper in their portfolio, and exposure to junior sector is a good way to do that. Whether it's Granite Creek or another company, I think it's a very good thing to have. And the other thing I would mention, potential supply disruptions. South America, Chile supplies over 30% of the world's copper. And as the countries down there move more to the left and in the political spectrum, we've seen potential supply disruptions, including a mine in Peru that supplies 2% of the world's supply, that keeps getting shut down as they work through the ESG issues and try to bring those mines into modern day. So again, potential supply disruptions, and really a massive new market coming online for these new energy sources, including the electrification of the global transportation fleet.
Yeah, and I think just on the supply side too, just there's such a push. I mean, in the US, there's the critical minerals list, and Canada has a similar list. Copper's not quite on it yet, but you're really seeing this kind of push for securing domestic supply of all of these metals. And you can't talk about any of these initiatives for greening of the economy and electrification and so on without starting at copper, really. I mean, the charging stations, like you said, the power generation sources, all of that. And then just in terms of the jurisdiction in Yukon, it's becoming a little bit of a burgeoning hotbed. You have Western Copper and their massive project that's kind of to the northwest of us, that Rio Tinto just took a big chunk of, and then our neighbors directly to the north as well. So a couple of things to highlight there, I would think.
Yeah, well, yeah, and back to the amount of copper used in electric vehicles. This is agnostic to the battery technology. So there's a lot of challenges if you're investing in battery metals, whether you go with a higher nickel battery company you want to invest with, you go with, or is there going to be a technology that reduces our need for lithium or cobalt or all these battery metals. But so far, no matter what the technology is, you still need the same amount of copper for the motors and the just the infrastructure within a vehicle. So the copper there's nothing really on the horizon that's going to displace it for those new uses. And even if you're looking at hydrogen vehicles, because most of the hydrogen vehicles, of course, they're still electrical vehicles. They're just using a hydrogen cell to produce electricity. So yeah, very, very good on that front. Yeah, and I'm glad you mentioned Minto as well. Of course, operating mine in our jurisdiction, just literally 35 kilometers up north of us, and currently producing copper with a projected guidance of around 260 to 270 a pound in an underground operation. And what I'd like to point out is we are proposing an open pit operation, and we see potential savings of over $1 per pound using an open pit versus underground. So, very interesting in that front as well.
I think that's actually a really important point to highlight, just with the Carmacks project, and it's got a bit of a history. A lot of people are aware of the project. It's gone through a few incarnations, and now we've landed on an open pit configuration. That's really, I mean, these grades for an open pit operation are quite something. So it's quite a bit different than it might have looked like to people that are familiar with it from the past.
Yeah, absolutely. I mean, one of the knock-ons on the project has always been that it's a small oxide play that, was probably difficult to put into production. And we've seen, a couple different companies take a run at it. And I understand why you would do that. If you could find enough oxide to get the long mine life that you would need, it kind of makes sense. But our approach had been to be a little bit agnostic to whether it was oxide or sulfide. Our current resource is split 50-50 oxide and sulfide. And we are now in the new PEA bringing in technology to process that sulfide ore and produce that long mine life that I think a project like this needs for it to be successful.
Yeah, and just for everybody listening, we're doing this in a little bit of a different order, I think, or a little bit different than we had intended. Brian's going to be joining us shortly, and we had intended to kind of walk through some of the macro picture and stuff with Brian, which we will. Meanwhile, we can just flesh out a little more on the project. And in fact, just jumping off your last point, Tim, there's an interesting question. At what stage do you start thinking about possibly streaming either the gold or silver? And how would you go about securing the best deal for that? Is that something that would be on the table? Maybe not the gold.
Well, I mean, of course, at the stage of the company is that you would look at royalties, you look at streams, especially as we advance the project towards feasibility. I think we want to get the PEA out and see how the new resources that we've identified affect the economics. And then we will look at ultimately what sort of financing structure you would use to build the mine. And that's where the streams or royalties even would potentially come into it. You got to be careful with the stream because you really cap the upside on your precious metals. But of course, it can be a really attractive non-dilutive means to advance the project if the right deal was there. So and I think in today's market, there's more than one streaming company out there, so that can really help you in moving that project forward. So it's not quite yet, but something that is definitely on our radar.
And just swooping in the nick of time, Brien Lundin, welcome.
Thank you. Great
Thanks.
to be here. Sorry for my delay.
No, that's quite all right. We were just having a little parlay and getting some discussion about the project going, but we can jump into some of the more general market macro things that we're seeing right now. I mean, it's a interesting time in the world, to say the least. And on the investment side, that has implications for people in all sorts of different ways. And so bringing an expert like yourself on to kind of help us unravel some of that and what you're seeing and what your thoughts are. So maybe I'll just jump in with some comments and we can take it from there.
Yeah, it is an interesting time, and I think it's going to get even more interesting. Across the spectrum, you'd be hard pressed to find a commodity right now that doesn't have a truly compelling story. And that's a rarity. I think it may be the only time in my investing career where you can look at every single commodity and come up with an investing case. In gold and silver, of course, those are the monetary metals, and there are issues with those we're very familiar with. One of the things that I'm not sure that everybody appreciates is that the Fed is in a rate hike cycle, and that has been bullish for the metals. It seems a bit counterintuitive, but the last 4 Fed rate hike cycles have been very good for gold and silver. In particular, the last one that started in December of 2015, we saw gold after that initial rate hike gain about 30% over the succeeding 8 months. And we saw junior mining stocks essentially double or more. Some go up 4 or 5 times in price. And that's a well-known, well-appreciated dynamic that I think we're in the midst of right now. I think the Ukraine situation has kind of thrown some noise into the signal, but we're in a bit of a stealth rally for gold and silver right now. And I think we're going to see that for months to come. But across the board, as I mentioned, if you look at copper, for instance, we have a situation where we have restraints on global copper supplies that are typical to the cyclicality of commodities, where, you know, high prices drive up production, which drives prices back down, and then lower prices constrain development and exploration, and then you have to go to that cycle that raises prices. What we have right now in copper is 10 or 15 years of underinvestment in exploration and development, which is bad enough, and something that, as I say, conforms to the cycles of commodities. But against that, we now have something we've never seen in history before, the transformation of the global economy toward electrification of transportation, toward green energy, that is going to demand not only the higher demand for copper for electric motors and those windings in those electric motors, but also the transformation of electrical grids to carry much more electrical usage for recharging these batteries. And then again, we have the battery metals, which is creating other areas. We have rare earths. We have the need for more power, which is going to create demands on uranium supplies. And again, all of these commodities have suffered from decades of underinvestment. It's not something you can get out from under easily. It takes typically 10 to 15 years from discovery to create a copper mine of any global significance. Now, there are a number of projects that are on the shelf or are being developed, but it's still going to take 5 to 10 years for them to respond. We're in the result of this is about 6 million tons of copper supply deficit annually. That would take the discovery and development of about 8 Escondida mines to close that gap. And we don't have that in the pipeline. We have nothing near that in the pipeline. So it's a dire situation for global economies, but it's a wonderful situation for investors who can go in and find investments, mining investments that leverage these underlying trends across the commodities. In copper in particular, I'm looking for companies that can perhaps leapfrog a lot of the development issues, or are in the process of expanding known deposits, not typically grassroots discoveries, but companies that have significant resources and perhaps have ways to advance those resources a bit more quickly. Those, I think, are in the sweet spot. Granite Creek, of course, is one of those companies that is, I believe, in the sweet spot. And you know, I think we just have the wind behind us. We have a tremendous cycle for commodities across the board ahead of us, and you want to be positioned in the sector.
So there's a million places I could go, but just thinking of, so in terms of the projects, that's a description in terms of the stage. What do you look at jurisdiction, for example? I mean, I just noticed, I think it was yesterday, that Las Bambas, pardon my accent, in Peru is being temporarily suspended.
Again, yes.
Copper production.
Yeah.
So is there a jurisdictional component to what you look for, Brien?
Yeah, you have to factor jurisdiction in to everything in your investment decisions. To overcome the higher risk of certain jurisdictions, you'd have to have a much more compelling project. but it's a big world. There are lots of jurisdictions out there, but there are also a lot of projects in North America that you don't really have to accept jurisdictional risk and go abroad, because things tend to go awry. They tend to go off the rails at some point in just about any jurisdiction outside of North America, Australia, and a few others. But the one thing you need to balance out against that is the typical time frame for a junior mining stock is a couple of years. So you're betting from that standpoint that things don't go off the rails within that 2-year time frame. And a number of the issues that do erupt in some of these jurisdictions are really issues that the next guy has to worry about. Because if you're in a junior mining stock, you're typically playing it for an eventual takeout by a major or a merger or some other kind of liquidity event. And some of those issues really are the problem, not your problem. They're going to be the problem of the major mining company that comes in to develop the project. That said, if there are significant issues in the country, it does act as a risk discount to the value of a project. So you do have to be somewhat concerned about that. But it's a lower concern for a junior mining investor typically than it is for someone or an institution that's in for a 5 to 10 year time frame.
Yeah, I think that's actually, there's a question on this, but I'll sort of paraphrase it, discussing North American projects in Canada, in particular. One of the relationships that you really need to establish, maintain, is with the local First Nations. Of course, communities in general, but the First Nations are a vital component to exploration, development, and ultimate construction and production. So, Tim, in Carmacks, maybe just take us through that a little bit.
Yeah, well, it's interesting. It's a challenge. And I would say that, I hate to blame something like COVID, but I would say that is set back our relationship building. Not that we have a bad relationship or anything like that, but we've not had the ability to sit down and face to face over a cup of coffee and discuss, community issues and values and that. But we're committed to doing that. Our relationship at this point has been virtual. We've had Zoom calls like this, where we've talked to members of the Little Salmon Carmacks First Nation and are working, together to try and foster that relationship. But we are looking forward to spending time in the community and learning and helping to advance a project in partnership with the First Nations. So that's where it's at. Like I said, if it in other times we would have spent a lot more time in the community, but we've been unable to, but we are committed to doing so.
Yeah, and I guess on that front as well, I mean, not to Lindsay Wilson, who we just recently brought on, and Lauren Blackburn, we have dedicated personnel who are, Lauren is Yukon based, and Lindsay's here in the office, that are dedicated to that, those initiatives and those relationships. So we'll be doing more of an introduction. I promised Lindsay I wouldn't make her turn her camera on, but she's watching. And we'll be participating in an event in Yukon, Invest North event in Whitehorse, actually early next month. So looking forward to that. And just actually as a detour, speaking of events, Brien, looking forward to seeing you in New Orleans.
Yeah, it's this year's conference is October 12th to the 15th, and it is it's the oldest retail investment conference, oldest investment conference really in the world today. We're celebrating our 48th year, and it's a great place to go to find like-minded investors, to get a number of big picture thinkers on macro and on every asset sector. And get information and intelligence that you're not going to see in the mainstream media. Every major event that's happened in the markets over the last 45 years or so, has been predicted and talked about in advance at our event. So it is the place to go and kind of soak up that intellectual energy from top people, in my view, in the business and in the macro picture, and of course, we do have a thread, a kind of a basis in the metals. We have a lot of mining companies there. And one of the things I tell people all the time is, What the beauty of the junior mining sector and the mining sector in general is that it's inefficient. You can take advantage of gaps in information, gaps in the market's appreciation of certain projects. And if you're willing to put in the work, a bit of money to attend conferences and subscribe to some newsletters, but time and effort to learn the sector, go to conferences, talk to management. There's a lot of assets now virtually like this event where you can talk to companies and experts in the sector. If you're willing to put in that work, you can take advantage of these inefficiencies and find situations that the market either doesn't appreciate or is overlooked. And that's where the big money is made. We've seen a few really big discoveries over the last few years, and a number of them that we were able to find in Gold Newsletter, but a number of them that were also found in other really good newsletters out there and by investors who put in that work. And we're talking about opportunities for really life-changing returns. And lots of companies that you can look at and look at these big picture macro trends and figure that in over the next year, 18 months, they are very likely to double, perhaps triple in value based on these macro trends and what they have going on. And have some confidence in that because you have been able to do that homework. And those are good returns. That's nothing to sneeze at, and they're available and out there to be picked up if you're willing to put the work in.
So just circling back a little bit, you talked about the Fed being in a rate hiking cycle, and just alluded to recently some of the big gainers that we've seen in the mining space. Obviously, Great Bear comes to mind. I think Philo is probably another one that have just gone ballistic before Great Bear was taken out. But
both featured in Gold Newsletter before their big wins, by the way.
That was me lobbing you one.
Thank you. I it's in the mail.
And I already mentioned that there's a special offer from Gold Newsletter, so I'll be sending that to in the chat window here in a second, so people can take a look. But I guess the question is, does this remind you of another period of time, or is this just new? Is it different this time?
It is different in a lot of aspects. It does remind me of some other markets. You know, in the in the 2000s, 2001, say to that first blip we had in the 2008 credit crisis. But in that period, and really it continued to 2011, we had a number of different drivers. One of the big ones was, of course, China. And China was growing at 10 to 12% annually, putting tremendous demands on commodities. But we really didn't see people investing in a lot of these commodities and a lot of excitement in the junior mining sector until we had an underlying bull market in gold and silver. And that's one of my consistent themes that I present to audiences and investors, is that for you to get a lot of excitement in copper or zinc or rare earths or uranium, et cetera, you really have to have an underlying bull run in gold and silver to bring in investors into the sector and get them looking around the sector, kind of seeing what else is available. The good news is I think we have that, and I think we're going to have that for a number of years to come. The other good news is that when they look around at the other sectors, they see compelling stories for the sectors and individual companies. I think we're going to continue to see that. You know, also talking about China back in the 2000s, we had, again, the country experiencing tremendous economic growth, whereas now those growth rates in China have cooled down to, 5, 6, 7%, something along those lines annually. So the growth rate isn't where it was before. But one of the things people don't appreciate is that the Chinese economy is about 5 times larger than it was in the early 2000s. So we still see tremendous demand from China. And we will continue to see that. And also those macro trends of electrification of transportation, et cetera, et cetera. Lots of things working in the favor for the metals. A lot of similarities, but some very important differences. And I think those differences are really compelling right now. They work to the favor of the metals. comparisons to the 70s in terms of inflation right now and negative real rates, but differences from the 70s that I think are crucial. We have debt loads right now, federal and corporate and individual debt loads like nothing we saw in the 1970s. You know, federal debt in the 1970s in the US was about 30% of GDP. Now it's about closer to 130% of GDP. That means that the Fed raising rates to fight inflation is a losing battle. It cannot do, if there was a Volcker around, he still couldn't do what he did back in the 1970s and early 80s by raising interest rates to 15% on the Fed 30-year T-bill. We can't do that now. We can't, in fact, get the Fed funds rate much over 2% without creating a tremendous debt service cost of over $1 trillion a year. It ain't going to happen. So at some point, the Fed is going to have to actually turn back from its rate hike cycle and start easing again. That will come either when the stock market tells it to do so, and the Fed will have to create answer to that request from the stock market, or we're going to see them run up against the debt service wall. It's where interest expense on the federal debt gets to unmanageable levels, and they have to lower rates again. So that when that happens, we're going to see, I think, precious metals prices soar, as well as commodities across the board.
You keep answering my questions before I get a chance to ask them. That's exactly where I was going to go with. I think it was 2018 was a brief, short-lived interest rate raising cycle, if you would call it that, and got to a certain point, what, 2%, 2.5%, something like that, and they had to reverse course, and things really took off briefly in that period of time. So yeah, you jumped ahead of me on that one, but good jumping off point for a question just about the general attitude toward mining. So I'll just read it, and maybe Tim, you want to give some thoughts, and then Brien take it. But so resource extraction in general has a problematic public image, and banks have become somewhat reluctant to lend to the oil industry, for example. But what is the banking industry's current attitude to mining? And what are we seeing in I guess, maybe in generalists, Tim, and just in the banking sector or investor sector, institution?
Yeah, I mean, there's a truthism out there, and that is that everything in the world comes from two sources. You either have to mine it or you have to grow it. And I think there's times when there's blinders on where the mining portion is kind of ignored, but I think that's coming around. I think banks are open because they recognize, in order to transition to the electric economy that we're all talking about, there's a phenomenal amount of mining that needs to happen, and the money as it moves away from oil and gas, because not only are we putting a damper on the use of oil and gas or anything carbon related, but we're also putting a damper on the funds going into it and investment in it. So that money's going to go somewhere, and it will flow towards what society wants, and that is to green everything and to electrify everything, so that the money will naturally flow there. And Brien, what are your thoughts on that?
Yeah, I think there's obviously, I've been chosen to speak a couple of times at mining industry conferences on ESG, which is such a big buzzword now. But and it's tough in mining. I mean, it is an extractive industry, and it does environmental damage just because it has to dig stuff out of the ground. Now, it can reclaim that and does, and that's the way we do it these days. A lot of people don't appreciate the fact that these mines are, the damage is mitigated, the mines are reclaimed, and that's a part of their operating procedure and factored into the economics. But fundamentally, it's hard to marry mining with ESG, and it's a battle that the mining industry is fighting. One part of that, the social aspect, is very important for mining companies, and it's used to be known as doing the right thing, but now it's called ESG. Mining companies that you should invest in, and groups that have been involved in more than one success in the industry, they do the right thing. And you absolutely have to establish the fundamental, the foundation of First Nations and Native relations, local relations. But it's kind of a sideshow to what the original question is, the banking industry and the availability of funds. There is a bit of a hurdle in the public consciousness that has to be overcome, and it's going to be different for each sector and each commodity. For copper, for lithium, for a lot of the battery metals, the argument is that the whole green transformation can't happen without this mining. It has to happen, and it's part and parcel of it. For gold and silver, there may be some issues down the road because, you know, gold doesn't really serve much of an industrial purpose, doesn't advance anything more than, you know, creating value in the form of 5,000-year-old money. So there may be some issues going forward. I don't think they're going to be going to place any real constraints on the availability of funding down the road. Interestingly, there was an article someone sent me today on the BBC saying, what if we stopped the mining tomorrow? What would happen to the world? And, you know, I can get the link and try and get it to you somehow, but and I'm not sure if I could actually put it in the chat or not, but the point is the upshot of that article was it would be a terrible world, and that we really could not do it. We would have ghost towns. We would have the economy collapse. So I think there's going to be an education process for the public where they have to show people how essential mining is. And I think they can do that. And I think they will be doing that.
Yeah, I think that to Tim's point about you need these materials if you're going to be having electric vehicles, and you're going to be having solar panels, and you're going to have wind turbines. So, you know, on aggregate, with the reclamation bonds and the environmental requirements to build the projects, at least in jurisdictions like Yukon where we work, you know, on aggregate, it's mitigated in a couple of different ways. I found that link, so I'll post it in the chat here in just a sec.
I think I just put it in the chat, actually.
Yeah, Brian beat you to it.
Yep.
It's there.
You're just beating me to everything. You're killing me.
There you go. Sorry about that.
So I guess on the permitting side, I just mentioned another question for Tim here to start. Are there any prospects that the permitting processes might be speeded up, and how might that happen?
Well, I mean, the best way to speed up of any permit in especially a North American jurisdiction is to do your legwork and build the relationships with the communities that help you advance that permit. The old way of doing it is, you know, you would kind of put the permit together in secret and then deliver it to local communities, and you know, you would be surprised by the comments that came back, where our approach is we are reaching out before we submit permit applications to get a sense of you know, what needs to be done. So that's really one of your best ways, is to build those relationships and to work in partnership as opposed to an adversarial approach.
Yeah, and I think at Carmacks, having a bit of a history and a few studies that have been done over the years, there's some degree of familiarity and knowledge of what things might look like, and the study that will be, I guess, here's one for you, Tim. The study that will be coming out in a couple of months' time here with the PEA will be a rather advanced level of PEA.
Well, yeah. So the one of the interesting things about the project, even though we've grown it so much, I mean, this project on a much smaller scale has been to feasibility a couple of times. But we chose not to take it to feasibility because of the growth of the resources and the addition of a sulfide component. So we're keeping it at the PEA level, but a lot of the engineering has gone complete to feasibility. The mine site, the size of the mill, access, power, all of that is at a feasibility level. So our hope would be, once we've completed that, you know, we will look to see if we're going to take that to feasibility and right after that. And then, yeah, on the permitting side, we are working to reinvigorate a new mine permit on it as we work through the PEA as well.
I want to just circle back in a second to what's going on today in the markets, Brien. Maybe we'll round it out with that. But first, Tim, question reads: If I read a map correctly, your active sites are on opposite sides of Yukon River from Highway 2. True or false? And is this a major problem, i.e. bridge building, that will have to be overcome? And this is infrastructure-wise, Brien had tapped this a little bit in Gold Newsletter about Granite Creek.
Yeah, so if you're looking at the map and you go directly from our project directly west, you're right, you hit the Yukon River. But if you follow that south, you'll find that where Highway 2 crosses the Yukon River, is on the same side of the river that our access is. So it's a long-winded way to say, no, we do not have to cross the Yukon River to access paved highway. Unlike our neighbor to the north, Minto, who accesses their project via a barge. So even though you're right, we're on that side of the river, you can go down through what's known as the Free Gold Road or the Resource Road, which is being upgraded by the Yukon government with federal infrastructure spending. Again, yeah, we do not have to cross the river.
Yeah, that's an important point, I think, to just really flesh out with that Free Gold Road and the development that's running right by our property, and it's really and past to Casino, but it's really nice to have that degree of infrastructure being built for you.
Oh yeah, whenever you have a third party building out your infrastructure for you, it's definitely positive for the project.
Okay, as promised. So I was up early this morning, and I think it was about 5:45 when gold was essentially flat. And then I looked again at about 6:05 a.m. Pacific here, and gold was down $15 and then $24. And so Brien, what happened today? And the Dow was up 400 last time I looked.
Yeah, I guess I'm not allowed to say I don't know, because I do want to pretend I'm a genius market pundit, right? But the fact of the matter is, when you see a drop like this in gold down about $25, it's apparent that some sell stops are being hit by the traders and the speculators. We did have a couple of things happen today. We had the big drop in the oil price, which I'm not quite sure at this point why. And we also had a big jump in treasury yields. The 10-year jumped over 2.9%. I think part of that is due to Fed Governor Bullard yesterday talking about the possibility of a 3/4 point raise at some point if needed and if necessary. And I think that is due to his statement, is probably due to a couple of factors. One is that they're trying to get as much done through rhetoric as opposed to rate hikes. So that's doing a lot of their work. And I think also to the fact that Bullard tends to be crazy as a loon and just has things off the cuff. So those two factors combined get the 10-year yield over 2.9%. But what is, not concerning, but interesting to me today is that we did not see any countervailing buying when the gold price dropped like that today. What we've seen over the last couple of weeks is that gold would have these rallies in the middle of a session, get hit in a bear attack, drop back, but then the bulls would come back in and buy on the dips. Indicative, I think, not so much of traders being involved, but real serious, deep-pocketed institutions making serious allocations to the portfolio and trading or buying and on the basis of algorithms, not trading on the basis of algorithms. And that whenever they see X percentage drop in the gold price, they take advantage of it, seeing a longer term uptrend. and trying to buy on the dips. We did not see the buying on the dips today. I think it's a sign that the traders have had their buy stops or sell stops hit, and have sold more and more as the prices dropped. One of the important things I think has changed, though, is that the sentiment absent today, the sentiment for gold has undergone really a fundamental change. If you would have, in some of my writings over the last few days, I've readers to go through a thought experiment or hypothetical that imagine you're in the gold market of a year ago, and somebody would tell you that in a year's time, the Fed funds rate, or actually the 10-year yield would be over 2.7%. Today, of course, is 2.9. The dollar index would be over 100. The Fed would be talking about raising rates at a half a point at every meeting for the foreseeable future. You know, and you would have a war going on. Well, a number of other factors. I forget all the ones I listed, but if you added up all these factors and asked what the gold price would be with all of those in that situation, you would have probably said around $1,100 or $1,200, the previous lows, because at that point in time, a year ago, all of those factors were deemed bearish for gold because the markets were just obsessed with Fed monetary policy. So if the inflation at 8.5%, you would say, well, that would make the Fed hawkish. So therefore sell gold, because anything that would make the Fed hawkish would be algorithmically and arguably, and for the traders, a reason to sell gold. Instead of having gold in the dumps because of all these more hawkish things are happening, we have gold approaching its all-time highs on a nominal basis and approaching 2000. So that shows that we've had a real shift in sentiment in the way the market looks at gold. It is being regarded as an inflation hedge once again, and not so much just because it's tracking the CPI tick for tick, but because people are worried about the very sustainability of fiat purchasing power. They're worried about what's going to happen to the purchasing power of fiat currencies in general and their home currencies and the dollar in particular. And they're using gold as a hedge again for that. You know, somebody was asking on Twitter I think yesterday, about why is it happening now? You would have thought that people would have freaked out about the purchasing power of the dollar and everything else and started buying gold a year or even 2 years ago. And my argument to that person was that they have to cross this critical threshold where all of a sudden everybody gets really worried, and that people don't freak out until they do. And when they do, then they rush into gold and silver and try to protect their assets. And I think that's what we're seeing right now, at least the early stages of that. So I don't know what's happening to yours.
Yeah, neither do I.
Little max headroom going on for you, Chris. But the point being, I think we've seen that change in sentiment, and I think it's very positive for the metals and commodities in general. And it's the start of a trend that I believe is going to last for years now.
Yeah, I guess the simple way of phrasing some of that is that bad news was good news and good news was bad news in terms of economic news that would come out. Because like you said, it was always, okay, how is the Fed going to react to that? Yeah. So I think maybe my camera is going bonkers. The fact of inflation being where it's at right now is probably sobered a few people up in that regard.
Yeah.
So I'm going to just jump back. A couple more questions came in. I'll just read this one. So I'm going to turn that off. Taking modern portfolio theory into account, a non-correlated asset like gold deserves a place in a portfolio to achieve an improved risk-adjusted return. What percentage of a portfolio should be allocated to gold, do you think?
Yeah, modern portfolio theory is very interesting. For many years, it dictated 5% allocation in gold as a non-correlated asset to get to that efficient frontier of really optimal risk-adjusted return. And there are some studies that show 10% or more, or as much as 20%. It changes all the time. Modern portfolio theory looks backward. One of the concerns I've had with modern portfolio theory is that it is backward looking, and those optimal portfolio allocations take in recent experience, usually going back 10 years. If you look past over the last 10 years, every market has been driven by monetary policy, central bank monetary policies. It is a trend that began in the 1980s, but really accelerated post 2008 great financial crisis, where everything was driven by the liquidity from the central banks. Thus, these correlations, these asset classes that used to be somewhat uncorrelated, the correlations have instead trended toward one, where this ocean of liquidity has lifted all boats, all asset classes at the same time, so they become positively correlated. Thus, the argument for non-correlated assets loses some of its strength, and in fact, modern portfolio theory starts to argue for greater concentrations, for example, in equities than it ever did before. Bonds were not correlated with equities. They were going in the same, not uncorrelated, they were going in the same directions. So all of the portfolio mixes are on the assumption that these trends will continue. And the trend that is really happening right now is one that began in the 1980s, and I think ends in a discrediting of fiat currencies and the ending of central bank liquidity funding all markets, because it's losing its effect. So yes, you should have some in precious metals. Physical metals is primarily what modern portfolio theory looks at as a non-correlated asset class. And it's traditionally been 5 to 10%. I think it should be around those levels right now, but I do think that the theory has lost a lot of its credibility or usefulness at this point.
Okay, just going to jump back to a project question. I think we'll maybe just take a couple more here. It's been almost an hour of everyone's time. It's nice to see that everyone is hanging on, but so Tim, this is going to a multi-part question, I guess, and we had kind of talked about this before, but you've talked about £1 billion of copper being something of a target or a threshold. Maybe just start with why.
Absolutely. So in talking to some majors, we know that £1 billion is a threshold to enter into a district. So before a major will look at a project, the project should have £1 billion plus blue sky. So we use that as an aspirational goal for the company. We use that to help us, determine where we were going to drill and how we were going to advance the project. I think, I read the question, Chris, and I think part of it is how much more drilling would it take? Well, we did, we increased from 43% to get to the 650 that we have. And, I think another sort of 15 to 20,000 meters of drilling, which could be completed in one season, but likely two, would get us to that threshold. If you use a copper equivalent, we're at 800 million pounds already. So, depending on how you spin it, we're much closer whether you use that copper equivalent or not.
Yeah, and I guess then there's people ask about exit strategies, and Brien alluded to this earlier with, typically the path is to look for a takeout. You get handed over to a larger company who is in the business of mine building versus the business of exploration and development. But in our case, one of the potential scenarios for the Minto district is some much larger player comes in and takes a look at what Minto Metals has and what we have and just says, okay, we'll take the whole bunch. And that's well over $1 billion at the moment anyway.
Yeah, and Chris, this gets back to what I was talking about, the inefficiency of the sector. You have two levels of inefficiency right now, where generalists are overlooking the copper exploration and development companies, and junior miners in general have not experienced the kinds of gains that the majors have. And even the majors are somewhat undervalued when you consider the money that they're making right now. So they have that broader inefficiency, but you also have a very specific inefficiency in that I don't think people realize how close Granite Creek is to that billion-pound threshold, and what that recent resource upgrade did. You know, the market has been looking the other way, and this is another example of something that eventually the market will have to recognize and will recognize. But it's kind of a window of opportunity that, you know, by taking part in this webinar, you're taking advantage of a bit of research that not everybody gets, and you know, and it's seeing an opportunity that the market really hasn't appreciated yet.
Yeah, your time, Brien, is much appreciated in this, and giving everyone kind of your insights on the market and on the company and the opportunity as well. And just catalyst wise, you know, an upcoming economic study based on this updated resource that you mentioned is a pretty key milestone coming up, Tim.
You know, absolutely it is. And if you look at the 2017 PEA, they had looked at processing about 11 million tons of oxide material, giving them roughly a 7-year mine life. So now we're now sitting on over 36 million tons of material that almost all of it, I think 95% of it, reports in the conceptual pits. So that, you know, if you can do a 3 times and see where we might fall in potential mine life and what the NPV might be, I think it's, you know, it's going to be a pretty strong project with pretty strong economics once we've completed that PEA. And we're very keen to be able to deliver that to the market and hopefully get the attention that I think the project really deserves.
Absolutely. So just to take us out, like I said, it is just after high noon now here in Vancouver. So maybe we'll wrap things up. Just a few things to keep in mind. One, I would encourage you, if you're on social media, if you're unfortunate enough to be on Twitter, then check out both Brien Lundin's, what is it? Is it at Brien Lundin?
At Brien_Lundin.
Right. And then we are at Yukon Copper. If you follow anyone, follow us too. Upcoming events wise, actually just this morning, a nice little interview with Alice Martin came out. You can see that posted on our Twitter page and elsewhere. We will, of course, be at the Vancouver Resource Investment Conference live in person next month. That is May 17th and 18th here in Vancouver. So I would invite everyone to visit our booth if you're in town. And of course, Brien's New Orleans Investment Conference. If you've never been to New Orleans and you've never been to the conference, go. With that, any parting thoughts, Tim or Brien?
Well, my parting thought is, if you're not invested in the sector, although I would guess anyone listening is, otherwise it wouldn't be on this webinar, but get positioned. This is, you know, everything points toward a lot of very rewarding months and even years ahead. These are multi-decadal cycles that are kind of coming to a head right now with some sweeteners that we haven't seen before in the history of mining and metals. So it is a time to get involved and come to my conference, subscribe to Gold Newsletter. We do try to find these opportunities in these inefficient markets. And of course, the conference is the place to talk to companies face to face. And there are always some wonderful opportunities coming from our exhibit hall and from really interesting insights that come from our presentation, our general session stage.
Who's your keynote this year, Brien?
Don't have so much of a keynote as a lot of great bench strength. I'm trying to focus on that more these days. But if you look on financial Twitter and look for the really smart people, just about all of them are coming to New Orleans.
Yeah.
And you can go to our website, neworleansconference.com, and get a listing of the speakers that have been invited or have confirmed so far. But it is an elite list, and you'll recognize. And of course, this is the place to go where you get an opportunity to actually mingle with the speakers. You don't get that opportunity everywhere else.
Yeah, that's really a great part. So just everyone check the chat. I've added the link to the special offer from Brien and Gold newsletter. So click on that and take advantage of it. And Tim, why don't you take us out?
Absolutely. Well, thank you very much, Brian. It was an excellent session. And Chris, thank you. And all the viewers who joined in. I encourage you to add the GCX symbol to your watch list. Follow along, watch the news that we're coming out. And again, look for that updated PEA. We expect it to be a real nice surprise to the market. And we hope it's going to be a major revaluation for the company. Thank you very much.
Okay, much appreciated. Have a great day, everyone, and great rest of the week. Take care.